All right, greetings and welcome. I am Mike O'Connor. I'm your host and the owner, sole proprietor of StockCheatSheets.com. Some of you may know me as the operator of the Chaikin Analytics fan site called Chaikin Power Users. Me and a trading partner, Double A, who I'm sure you're going to see on the Cheat Sheets channel, have been reviewing the market every day for about 12 years. And Mark Chaikin's system, which he recently sold to Stansberry, is really incredible. I was in on the ground floor and got to be an affiliate. And boy, I'll tell you what, that app is really something. It can, he's got a series of 20 fundamental qualitative metrics that he uses to analyze the most important catalysts for a stock appreciating in price over the course of 3 to 6 months. That's combined with some technical indicators like Chaikin money flow, for example, and some proprietary moving averages and volatility bands into one really sweet app. And I love it. We still use it. We still host videos on behalf of the Chaikin Analytics folks. However, and I don't make any money from them. That's how big a fan I am of that. So we've kept the affiliate site alive past the sale, even though there's no longer an incentive. But listen, there's one stumbling block with Mark's system. It's not for everybody because it's expensive. You know, occasionally they'll run a sale, but it's about $2,000, $2,500 a year. And for newer intermediate traders, even advanced traders that just don't have a big enough bankroll, on a percentage basis of capital committed to trading strategies, it may not make any sense at all to invest in that kind of money into a kind of a guiding info tip sheet, as you were. I mean, it's way more than a tip sheet. But again, it's not for everybody because of its expense. Cheat sheets are free right now. Parts of cheap sheets will become premium, but the most we're going to charge is $5 or $10 a month. So we're trying to serve a completely different niche, and we're not repackaging any of Chaikin's stuff, although we're going to use his money flow indicator, which is universal. Cheat sheets is a combination of some off-the-shelf indicators that I've come to rely on over my trading career and a few unique twists that I've put on them. And it's the combination of indicators that really comprise the cheat sheet ecosystem. And so today's video, we're going to try to do two things. We're going to do a weekly recap. The market is about 45 minutes away from closing, and it's been a bullish transition week, and we have to figure out if this is just a fake out bear market rally or whether we've bounced off at the very least an intermediate bottom and perhaps a longer term bottom, and are we poised to rip higher for the rest of this year? You know, we're trend traders, so it really doesn't matter. We just want to cherry pick the things that are going to run, and we only have to be right 40% of the time. And if we do that, and we let our winners run, and that means coming up with stock losses that sort of follow a moving average up. You know, as long as you win twice as much on average as you lose when you're wrong, you can be wrong most of the time, 60%, and you'll still make 15% a year, which is almost double what the average financial planner puts into their modeling expectations for investment returns over the long run. Imagine if you can double that and do it consistently. Now, this is not easy money, and it's there's a lot to it. But in principle, if you develop some basic trading skills and the market cooperates, it needs to trend, you can do very well over a period of years. And maybe that means catching up if you're retired. Maybe it means you're just starting out in your 20s, and it could be an early retirement for you. So I will teach you how to trade a little bit in these videos, but I'm not a licensed investment advisor, and everything we're going to do is basically on the honor system that we're doing this for educational purposes. Okay, but cheat sheets are a guide for you to use. It helps you focus on the parts of the market likely in play, whether you incorporate the trading signals that I provide along with cheat sheets, or just incorporate my info into your own system. You'll be better off by having access to this, and it's not going to cost you anything. Well, and some of it might cost you $5. So I don't think there's a lose-lose here for anybody. And so that's what we're going to try to accomplish today. Now, there's way more than I could possibly cover in 30 minutes or so. So we're going to take this in broad strokes, right? But I created this channel for a reason, because I'm hoping to host a number of videos each week here where we'll focus on different trading strategies, what the trading signals mean, what the pre-trade checklist looks like, and there's two different cheat sheets. So let's start with that. And what we're going to do is I just pulled some metrics out of my platform and into cheat sheets just before I came on the air here at 24 minutes past the hour. We're about 35 minutes away from the close. Okay. All right. So let me expand things out. And here, there I am. I guess I'll continue to say hello. So what you're looking at is a screenshot. Let me see if I can't make that bigger. It's going to be awkward because I'm going to have to move things around. But I just want you to be able to see it. So cheat sheets. There's two types of cheat sheets. One that I'll call trading signals. And this is more of the real-time cheat sheets, the one that will draw your attention to a bunch of different scores, and you can make a decision about whether or not that stock is in play for you that day or a candidate for your watch list. And then there's something longer term that we do on the weekend called relative strength analysis. It's really the keys to the candy store. There's a famous hockey player named Wayne Gretzky who once said one of his secrets, and this guy could skate like lightning. He was a mofo. But he always said that what he does is he skates to where the puck is going to be, not where it is. And so it's that anticipation that relative strength analysis gives us the ability to sort of forensically like stick a bloodhound on institutional investors who are the market, and figure out how they're putting their money to work. And we just want to be little minnows following the whales in and out of trades. All right. And that's what relative strength analysis is about. So what you're looking at is cheat sheets, and they're really divided into two areas. We have obviously the column on the far left here, column C, is basically tells you when the cheat sheets were updated. This actually was updated intraday today, despite what it says here. I just didn't change it. And then we give you a tailwind score. I'm going to come back to that, what it means. And then you'll see a checklist of 10 different fundamental metrics. Pre-trade checklist. And it's really not fundamental. I'm sorry. It's a combination of different metrics. And the more green lights you have, the better the odds are that you're stumbling into something that has the potential to trend and go higher. This is a bullish trading system. So everything we're going to talk about today is essentially when the market goes up or individual securities go up. And the time frame is weeks to months. So this is not a buy and hold system, but it's also not a day trading system. The idea here is to catch things at the beginning, never at the exact bottom, but as they're beginning to trend. And the more green lights come on, the more confidence you'll have that the direction of the stock in the future is likely higher until the red lights start appearing. So you do have to have a risk management system, and we'll talk a little bit about that. And so that's what this pre-trade checklist is all about. And then to the right, and I'm going to go back over here and kind of move this so you can see that we have about 9 different trading signals over here on the right-hand side. And the idea is to balance kind of the two things. The pre-trade checklist is the homework. This is a bunch of different indicators that, when taken as a whole, can be rolled up into an overall score that's 0 to 100. Now, you'll see none of the major indexes crack 50, which is my minimum score for even thinking about taking action, unless there's just some very specific trade that I want to make. All right. So obviously, here we're pressing at that 50 level. And that's kind of symbolic of the two themes that are in play right now, right? There's, I'd say, two groups. There's the Armageddon group that says, not only is the economy slowing down, but the Fed is doing the absolute wrong thing by aggressively fighting inflation that's no longer there, despite the look back metrics that have been obviously pretty unbelievable, right? 10% year over year inflation, at least through June. Producer price index and consumer price index. All right. So these folks are thinking it's the worst of all possible worlds. And some of them are even thinking that this is the crash for the ages. We've only seen the first step. The first 20% down was multiple contraction, basically meaning that we don't value growth as much because there's not going to be as much, and it's going to be harder. And therefore, we're not going to put the kind of premium we used to put on that. And so stock market multiples shrunk from 22 to 1 forward-looking PE to around 14 or 15. Well, for those of you who are old enough and have a trading career that spans into the financial crisis, you'll remember the markets got down to single-digit price to earnings ratios. And so that's kind of the theory of the bear's case for the back half of this year, is that the next thing that will happen is as companies announce Q2 earnings, they'll start talking about forward guidance for the year. And many expect them to be very conservative and perhaps to guide down. And analysts would follow suit, of course, and then make adjustments to their forecast. Because right now, analysts are pretty much all euphoric, right? The average analyst is expecting, although it's come in a little bit in the last couple of weeks as companies have announced, hiring freezes and layoffs and not replacing positions and, kind of the preliminary pre-recession sort of fiscal management that gets done as companies try to manage their way through things. But what's happening is the analyst estimates are still pretty robust for next year. On average, 8 to 10% corporate profit or earnings growth. And so if they start marking down the earnings, and collectively that changes the equation, right? We've taken multiple down, and now we would take corporate earnings down. Remember, it's E times M that equals P. Price can shrink, and then obviously the multiple, the value that gets placed on those earnings changes the dynamic to where we potentially get down or we'll need to get back down. If the P stays the same and the M stays the same, but the E gets heavily discounted for next year, it means the forward PE in the stock market is probably too expensive, and stocks will sell off to meet the kind of the new reality. And that's what that camp is expecting. Now, the other camp is saying, nope, the bottom is in. The fact is that the Fed is simply moving forward from the future its rate hikes planned for next year. It's going to give it to the market all in one shot. The market's already discounted that action. Corporations are announcing decent earnings so far, about 20% into the earnings cycle, and managing their way through inflation. They're drawing down on inventories through sales this summer, and are not going to over-order and do stupid things, and are going to be conservative about personnel. But the fact is that how can you have a recession when there's more job openings than there are people to fill them? And that's we bounced off the bottom. The market has discounted things. Now, they don't necessarily, they're not necessarily singing a chorus of ebullient bullish praise, expecting massive explosive growth in the markets, but they're at least saying the crash is not, a continuation of the crash is not likely. All right. And so as a result, we sort of have this mid-level tailwind percentage, which rolls up all the key, I call them minnow metrics, right? It's minnows following whales. And here we are, the Qs, the diamonds, IWM, small cap, SPY, all roughly in the upper 40s, emerging markets, bonds, that's TLT, that's the 20-year note. We use this in the index here. And for some reason, I don't know why, there's my 7 to 10-year ETF has dropped out of the cheat sheet. I don't know why, but it kind of looks like TLT. And then ACWI is the All Country World Index. That's important. That's a benchmark that we use to compare ourselves to the rest of the world. And then Europe, Far East, and Australia, sort of the rest of the world developed economies, ex-US. All right. And so that's how we're stacked. It looks like the US is a little bit better place to do business, though this is not a relative strength report. So this tailwind percentage is fed by these metrics here. So I'm going to actually move on to the most liquid ETFs to give you sort of a different look. You have to forgive me. I'm going to have to come back to StreamYard here and just make sure that you can see everything, and you can. So most liquid ETFs here, stack ranked in descending order. So let's talk about what this pre-trade checklist means. It's broken up into 3, maybe 4 sections. I think 4 is appropriate. So the first is the reality of the trend. The long-term trend checklist item number 1 tells me whether or not it's the relationship between the 10-week moving average and the 40-week moving. These are exponential moving averages. So right now, bearish means that the 10 is below the 40, and that means that we have a long-term bearish posture in just about every index, with the exception of oil, USO, and utilities. And there's a short bear market small cap TZA that's still got a bullish long-term posture, but bearish problems elsewhere because the small caps have really recovered, especially this week, and so on and so forth. This is a list of the most liquid ETFs from around the globe, tightest bid-ask spreads. If you're an option trader, this is the list you want to focus on. It's got gold, oil services. There's Mexico. There's the euro. Euro had a surprise ECB announcement yesterday, where they, out of thin air, after 14 years, they actually tightened, and the euro dollar spread came in a little bit. And that's kind of what has catalyzed stocks a little bit. The dollar's been on fire, but with the euro's relative value now boosted a little closer to the dollar, 50 basis points, nothing to laugh at. Dollar weakness resulted in a fairly decent equity rally over the last couple of days. When I last checked, we were pretty flat going into the close today. All right. And then there's retail and consumer staples, and you get the idea. So these are stack ranked, and this is one of many different stacks that comes with cheat sheets. So think of a stack as a curated list of thematically of ETFs or stocks that share a common theme. In this case, this is the most liquid ETF stack. So it's basically the ones that are going to give you the least slippage and more likely to have options associated with them. And this is a quick way to get a big picture. And so the first thing we're looking at in this stack is the long-term trend, which is bearish for the most part, at least among the top performers. These are the ones that sold off hardest, broke long-term trend, and are now in recovery mode. A new development this week is checklist item number 2. The intermediate trend on a lot of our top performers, the ones that are over 50 with their tailwind score, which is the bare minimum we need to consider a trade for them. Okay, that's very important. Green is good, red is bad for bulls. All right. The intermediate trend means that the 10-day exponential moving average is higher than the 40-day exponential moving average. So bullish or bearish long-term posture, bullish or bearish intermediate term posture. This is my key time frame. This is a very important pre-checklist item. If we're in an intermediate trend or we're just starting one, I'm very interested. This is the kind of trend that lasts a few weeks, if we're lucky, right? Because every once in a while you get whipsawed out to several months, and the longer the better. And we try to use some of these other pre-trade metrics to kind of estimate what we think is going to happen, right? How strong is the emerging intermediate trend going to be? Now, the short-term trend is probably the least important metric here. It's the 10-hour over the 40-hour exponential moving averages. So really, we're talking about 2 days, a 2-day versus 8-day moving average pair. Now, I'm probably going to change that to 50, 20 days, because I think maybe that's a little too short term. But the point here is this is the type of trend that you basically, it's counterintuitive. When it's bearish and the other two senior timeframes are bullish, that can actually be a good thing, right? Because that means stocks are pulling back in the very near term, and a bullish cross or a transition from bearish to bullish, while both of these moving averages pairs are bullish, it gives you another entry point. So that's how I use this. The short-term trend is nothing more than a way of gauging, are we in a pullback? And by the way, we're not just in a bullish pullback unless both lights are green. Okay, so 2 green lights and a red light, I'm paying attention because I'm then looking for an opportunity to enter. Okay, and that's how I use this one. Also for timing for covered calls or options that you might write against your holdings that give you a chance to develop income. One of the ways to time that is, again, when you are in a stock that has a bullish long-term trend and a bullish intermediate-term trend, and the stock has been running, but then suddenly the short-term trend goes from bullish to bearish, that's telling me that the 10-hour moving average is crossing below the 40-hour moving average, that we're at the beginning of potentially a pullback. It could be just a very minor 2 to 5 day pullback, or it could be a more substantial and prolonged pullback. But I use that to time my entry into covered call trades when I'm doing something called legging in. Buying pressure. I'll be very transparent. We use the Chaikin Analytics, or I'm sorry, it's not Chaikin Analytics. I'm not stealing anything from Chaikin. It's the Chaikin indicator called money flow. And essentially, I've broken it up into 3, maybe 4 segments on the bullish side. So a stock has to have a money flow score of better than 0.2. For those of you who've actually seen the indicator on the charts, that's a pretty robust number. All right. Above 0.1, you get a bullish rating. Above 0.05 to 0.1 would be neutral plus. Below 0.5, now we're neutral. So from positive 0.05 to negative 0.05, that's the neutral zone. And then below negative 0.5 to negative 0.1 is going to be neutral minus. And then below 0.1, we start getting bearish. And below negative 0.2, we're very bearish. Okay, so buying pressure. Basically, this is a snapshot of institutional demand for stocks. And it's measuring essentially whether or not the stock is closing near its high for the day or not, and whether there's a lot of volume associated with a closing that's nearer to the high, right? So think of it as an accumulation distribution score. Buying pressure is not necessarily most effective measured as a snapshot in time, but more a persistency score. So you'd love to see a very bullish Chaikin money flow, or buying pressure as I'm calling it here. But it's sustained buying pressure that's really what's important. Think of it like when you turn the spigot on a hose. And, it always takes a little while for the hose to sort of fill up before you get pressurized water out the other side to squirt your dog or water the grass with a spray gun. And so think of buying pressure that way. You want it to build. And generally speaking, buying pressure builds on a stock ahead of price moving, right? It's going to, and think of price as the water coming out of the spigot. So we love to see a very bullish buying pressure number, and that helps contribute to the overall tailwind score, but we need other things to happen as well. Relative strength is incredibly important. So normally we compare stocks to the SPY, the US large cap benchmark, but I'll tell you that we're in transition right now, and this benchmark reading is going away. I'm going to compare, for the purpose of these trade entry cheat sheets, I'm going to compare stocks, including the SPY, against the Russell 3000, the top 3,000 stocks in the US, the IWV. The reason I need to do that is because relative strength adds points to the overall tailwind score. Otherwise, I'm going to be punishing SPY in perpetuity by not giving it the chance to earn points for outperforming the broader market, okay? And I've already put that into place. So despite the fact that you're seeing benchmark right now, by the time Monday rolls around, I should have fixed everything, and it'll actually have a relative strength score. So the tailwind score is accurate. Obviously, I'm not showing you bullish or bearish metrics, but it's approximately like the Dow. Maybe not quite as good as the Dow. All right. And so just to pick up some speed here, we're using the RSMK indicator, a quantitative indicator that allows me to determine whether or not something is outperforming or underperforming a common instrument. In this case, we're going to use the IWV, but also the magnitude of that outperformance. And so essentially, a very bullish means we're really outperforming on a 6-month look back basis. And a very bearish means we're really underperforming, and then there's going to be different ratings in between. You want at least a neutral plus on a relative strength rating. And this is a way of comparing the security to the broader market. All right. And we look at 2 different time frames, and there's points that go into the tailwind score for outperformance in the 6-month look back period, or 180 trading days, and the 3-month look back period, or roughly 60 trading days, give or take. Okay. And so that would be sort of the next bucket. So the first bucket where you're moving averages, the next bucket is relative strength. And then really this is a final bucket, but there's really 2 pieces to it. And this is the one that's too complicated for me to explain in detail today. But we're using a series of oscillators called, on the TD Ameritrade platform, called the market forecast, right? It's a 4-part indicator. That's what makes this really powerful. And it's how these discrete indicator pieces play and interact with each other that sort of really determines our buy signals. So the long-term forecast is the one it's the big ruler. It's the granddaddy indicator. This is the one where the time frame is months to maybe up to 2 years, but on average, about a 9-month time frame this is covered, okay? And a bullish reading or better is really important. That's when we have a bullish reading or better, there's a good chance that we're going to have a multi-month uptrend. Now, right now we're at neutral plus, which means we've just recovered from very bearish and we're just beginning to turn up. So actually the point we're at right now with this long-term forecast probably gives traders the biggest opportunity for big gains because of long-lasting trends if, and that's the big question, is if this reading can sustain itself and progress from neutral plus to bullish and then very bullish. All right. That'll probably represent about 9 months worth of trending if that happens. So think of this as the path of least resistance, the long-term market forecast. When it's pointed higher, meaning it's neutral plus or better, it will support bullish rallies and it will negate or minimize bearish drawdowns. Okay. So it is the path of least resistance indicator, the longest term of our 4-term timeframes. Okay. Now, the most important to me is the intermediate market forecast. Now, these back here, 1, 2, and 3, these were actual trends, 7, 8, to a less extent, 9 and 10, but all of them are forecasting instruments. They're oscillators that are gauging the momentum of price in different time frames. And the reason they're a forecast is obviously if something is already going up and these oscillators are showing increased momentum, well, that's like acceleration. So think of, let's use a car example, car down a highway, right? If you're cruising comfortably at 45, 50 miles an hour, great. It means you're underway. The journey has begun. That's our metaphor for trend, right? Meaning over here, we're on the highway and moving here. Okay. And we're, a short-term trend might be side streets. Intermediate trend might be state 1 or 2 laners. And then think of the long-term trend as your 4-lane highway connecting different major cities in America from coast to coast. Okay. So the forecast is telling you whether we're picking up speed or slowing down in different time frames. Obviously, the acceleration and deceleration of the long-term forecast probably is going to mean moves like, oh my God, there's a cop ahead. I better pull back from 75 miles an hour and get back down to 50 or 55, right? And then, of course, you have your side street stuff here in the momentum indicator where I'm just accelerating after making a hairpin turn in the city. All right. So momentum indicators across multiple time frames. And the same sort of thing. Neutral plus is the minimum we want on each of these to feel good, at least on these first two, 7 and 8. Now, the near-term forecast is what I'd call one of 2 junior timeframes. These would be senior forecast timeframes. These 2 are junior timeframes. And so, again, the intermediate forecast is weeks to a couple of months. Ideally, 1 to 3 months is typical when the market's long-term forecast, sometimes you'll hear me refer to the long-term forecast as sentiment, is particularly strong. Usually an intermediate forecast that's very bullish has the potential to run 90 days or 3 months. Also, when the long-term forecast is extremely bullish, it's likely that there's 3 cycles of intermediate 1 to 3 month trends ahead. That's why this long-term forecast matters so much. So a trend unit, 1 to 3 months, the long-term forecast can tell us how many of those units are likely. So again, 1 to 3 month trend units translates into potentially 6 to 9 months in terms of an overall long-term trend. Okay. Another way I've heard this all described is you've got droplets, when water drops and water rings out. That's kind of one level of price action. And then there's waves, crashing on the beach. And then there's tides, right? And so think of the long term as the tide, the intermediate term as waves crashing on the beach, and the the near-term forecast is ripples in the water when you throw a stone in it. Okay, different intensity or magnitude of price movement. All right, and checklist 9 and 10 junior timeframes are often used to trigger buying signals based on what we're seeing in the senior timeframes. So when the senior timeframes are going up, we do want to see junior timeframes take a breath and slow down a little bit. That's going to be our pullback, right? And as long as the pullback isn't too dangerous, then we feel good about entering the longer term trend. But when that forecast in the near term, and momentum, by the way, 1 to 3 days, it's kind of the day trading time horizon. When we start heading into the danger zone, and you'll see we've got heads up, danger zone, neutral, and bullish. Those are kind of the three, the four ways we describe momentum, and the near-term forecast is similar. So we like little pullbacks. We don't like major pullbacks, which can cause directional changes. All right. So it's the interplay between these two sets of time frames that are forecasting what happens over here. And then the relative strength is just it separates different levels of price appreciation based on 3 and 6 months of relative price performance. So all of these things together, you'll notice there's no fundamental metrics. This isn't does the stock pay a dividend? What was the price earnings ratio? Did management beat their earnings forecast? Nope, it's none of that. We're assuming that the big money whales who are the market have access to all of that information. They have financial analysts on the staff who crunch balance sheets and project what a company is worth relative to where its share price is. And all of that work is being done for us. All we want to do is follow the big money. So it's their behavior, how they're buying, the extent to which they're buying, how fast they're buying, whether the buying is accelerating, driving price up, or whether it's slowing down, or worse yet, that they're trying to sell everything that moves to get out of an oncoming train that they see coming. That all can be picked up in this combination of factors. So if you're a geek like me, you're going to enjoy the amount of drill down time we spend in these videos, kind of going over what's likely happening. But a lot of you are just like, just give me the fucking bottom line, will you? That's what the tailwind score is. Okay. It's like, and really the bottom line is, if you've been watching my blogs on, let me say it again, stockcheatsheets.substack.com, you'll notice I've been into healthcare and biotech. It's been one of our better performers. But there's also and that's a defensive play in a bear market. It makes sense, right? What doesn't make any sense to me is why home builders has got such a high tailwind score. But it does, and we have to respect that. I've actually traded a home builder's option trade bullishly this week. Now, again, whether the market is going to rally intensely for months and months, or whether this is just a short-term bear market rip, it doesn't matter. I've got escape hatches on all of this stuff. I'm not married to any of these trades. I'm kind of renting my association, right? We're having an affair, a fling. But as this data gets more and more green across more and more places, we can't ignore the numbers, right? And so that's the other thing that cheat sheets will do, is it'll really your head drives and your heart takes the back seat, right? We got to get rid of the emotions and stick to the numbers and our risk management. So home builders, what's really going on? Let's do the pre-trade checklist. Intermediate trend, the 10-day moving average is trending higher than the 40-day moving average. And there's a short-term confirmation trend that the price is accelerating now. It hasn't slowed down yet. Buying pressure likely came before these trend changes. It's as bullish as it can be, with a reading of above 0.2. Now, the relative strength hasn't kicked in yet, and that's typical of bear market recoveries, right? We have long-term strength is bearish, and the 6-month relative strength versus the IWV, the broader 3,000 stock market, not the SPY, is bearish. So there's been, the home builders got thrown out with the bathwater. But over the last 3 months, we've begun to outperform the market. So we are in a transition through our sweet spot, which I'll explain more in a minute. Okay. So we sort of get half credit here. And then the long-term forecast, at least, to stop going down. Meanwhile, the intermediate forecast is bullish. This is actually very robust here. And it's confirmed by the junior time frame, which is saying, yep, we're bullish. We're on the, we're on the upside of 50 on that oscillator. All of these oscillators run 0 to 100. I'm just subdividing them into different sections. And so for those of you who don't like reading charts, this is just green light, red light system. But again, I always take these, what I do is look at what's performing and where it's performing, and then immediately go to the charts here. So we'll be doing some of that. We're going to be, relating these metrics to a chart. But today I'm just kind of reviewing this stuff, so it makes some sense. All right. So we've got very bullish near term, intermediate term, at least non-negative long-term forecast, and we don't have any momentum slowdowns. Nothing that's falling into the heads up or danger zone. We don't mind the heads up so much. But it does cause us to, be extra cautious. But the danger zone, that can really derail trade. So we do want to be respectful of that. Okay. And then there's a bunch of signals, none today, that will reflect from that combination of pre-trade checklist items. The market forecast, entry signals are here, and moving average crossover signals are here. And so as they flash, I'm going to explain them to you. But when you go to stockcheatsheets.substack.com, there are user guides to help you interpret all the signals as well. And they are they're pamphlets that are getting better. Pamphlets, geez, listen to me. They're pages with a lot of content on them that I'm going to keep refining and add videos. I want to make this as easy as possible to use cheat sheets, but I am literally a one-person show here. So it's going to be a little slow going, but it's free. All right. So some other signals we can look at. Oh, here's U.S. sectors. All right. And we do have a trading signal to look at. So right now, in terms of tailwind score, the only thing that's really above the 50 in the U.S. is healthcare. Tech obviously had a pullback today. I think Snapchat's earnings sucked, and so tech got sold off. So it's hovering around 50. It was above 50 yesterday. I actually took a trade on the XLK based on a moving average cross. So relative strength has pulled down a little bit negative versus the market on tech. That's new and recent, probably as the result of today's price action. But overall, the buying pressure is there. Nope, we haven't recovered the long-term trend yet, but the intermediate trend, just under it, the 1040 moving average pair is bullish, and the 10-hour, 40-hour moving average pair is bullish. Our market forecast looks good to me. We're at least not negative in the long term, and we're bullish above 50 on a 0 to 100 scale on the intermediate market forecast, suggesting follow-through. On the near term, above 50, suggesting confirming that follow through. And the momentum line that they sold down the market due to Snapchat today, but notice that it's still in the neutral zone. We didn't get that heads up zone. All right. So TLT, what to make of it? First thing I'll tell you is that when I see an entry signal over here, I immediately look at the tailwind score below 50. I'm really skeptical. But occasionally there's a reason to take a trade below 50. So I'll give you my workaround, okay? Because a medium-term entry signal, that's the 10-period moving average. And in this case, because it's the intermediate term or medium term, it's the 10-day moving average crossing above the 40-day exponential moving average. That's happening into the close today. Bullish sign? Yeah, but 35 is a long way from 100 and a long way from 50. And there's some problems with it. So there's two places I look if we have a score under 50 that I look first to determine whether I want to spend any more time evaluating the trade. First is trend, okay? So when we're in a bear market, we have to understand that trends emerge over time. And so what I look for is at least one of two to be bullish or better, or at least neutral plus or better, but preferably bullish. 1 and 2, one of the two has to be green. Okay, so yep, we got that here. And then I immediately go to buying pressure next, because what you're hoping to do is we're trying to game the system and anticipate where the puck is going. Buying pressure with at least one set of bullish moving averages implies to me that this moving average crossover has some support here. But the buying pressure on treasuries is negative. Remember, treasuries work inversely to interest rates. So if the Fed is raising interest rates, do you think there's now there's going to be a point where they raise them enough to where actually holding a bond might be attractive. But right now it's paying, at best a third, probably more like a quarter the rate of inflation. So why would you want to own that? And of course, nobody does. So Fed is raising rates. We're bearish. Rates go up, bond prices go down. Okay. And so that is not a signal I would take. I really want my signals to be up here in the bullish zone, and they're not. Today's a pullback day, and not yet maybe enough of a pullback to get into these. And now the market's closed. So my data is a little bit out of date. And so I think that's enough on trading signal cheat sheets. There's a lot more work to do. I'll tell you that when you go to stockcheatsheets.substack.com, there's a ton of different, what we like to refer to as stacks here. That's what these are. This is, for example, the subsector stack. So we looked at indexes first, and we looked at sectors, and we found that only healthcare was, in bullish zone. And then probably won't surprise you at all that biotech, a subsidiary or a subsector of healthcare, also has a tailwind score. So suddenly now we're doing a top-down analysis, right? We're finding the strength in the market by looking at the parent sector first and then the junior sector second. And here XPI at a 70 tailwind score is pretty good. I'm waiting for an entry signal. Now we got one on solar today. Let's go through that. TAN, buy the dip. 81% tailwind score is excellent. Still doesn't have a long-term trend, but the intermediate and short-term trends are bullish. The buying pressure is strong, suggesting that institutions are along for the ride. We're outperforming the market in both the 6-month and the 3-month time frame. And by outperforming, we don't necessarily mean going up, right? You can outperform by going down less when the market is going down, and you can outperform by going up more when the market is going up. Okay, so these are both very bullish in the 6 and 3-month look back period. And then the long-term market sentiment, the forecast for the long term for months to a couple of years, 9 months on average, is bullish. That's a big deal. That means we're above 50 on this oscillator and we're above 50 on this oscillator. That's not happening anywhere right now, as you can see. So solar, and you'd think with the Joe Manchin kind of kiboshing the short-term solar expenditures or the new energy expenditures that are going to be made by Congress, you'd think that this would have rolled over and played dead, but it shows you why you can't let the news guide you, right? It's these senators may be saying one thing and doing quite another, but somebody's buying, despite the negative news this week. And I don't entrust the integrity of the U.S. stock market at all. You know that there's tons of trading by the biggest money center banks on non-public information. So that's why we pay attention to the data and not the news. Okay. So the near term, we're in the neutral zone. We got a heads up. That means that at least earlier today, before the close, they sold this a little bit. A heads up means that we're, dipping now below the 10% mark on the 0 to 100 oscillator, but we don't have a problem unless we dip below 5. So I definitely check that. If you have TD Ameritrade, we don't want to trade anything that pulls back to the extent that it's in the danger zone, because it likely means that we're not just catching a bounce, we're catching more likely an intermediate consolidation, which could last a few weeks, or a trend reversal, which means you could be walking into a trap where you lose money. So the danger zone we want to avoid. This is okay. And that's what this signal is telling us. Buy the dip has to have 3 things for it to be a good one. Okay. The intermediate time frame of the market forecast has to be a 5 or 6, bullish or very bullish. Neutral plus doesn't cut it. Although some would argue that you could take a neutral plus by the dip trade. The fact is, I don't allow that to show up on these cheat sheets, okay? Think of it like training wheels. I only like buy the dip when the intermediate forecast is bullish, and I definitely need at least one of the 2 senior time frame trends to be bullish, and here we've got it in the intermediate. That's the second thing that has to be true. There's 2 other things. This cannot be bearish. Number 9, the near term can't be bearish. And 10, we have to stay out of the danger zone 5 reading. Okay. Meaning if the momentum falls into that bottom 5%, we don't like the trade. Okay. So this as a light red or better, this must be green. This must be green. And one of these two must be green. And then you've got a wonderful buy the dip signal. And I'll get into intermediate trend confirmation because I've gone on quite a long time. And that's, in fact, all we're going to do today. I'll tackle relative strength on a separate video. But let me, before I go, let me show you one other thing. This is semis. Now, I'm using XSD, which is a much more thinly traded semiconductor ETF than SMH, because most of these are the S&P 500 subsectors, and it's just for consistency's sake. I kind of learned it from my time with the Chaikin Analytics app that does the same thing. It's got its parent S&P 500 sectors, and then its junior subsectors are all part of S&P. Listen, I'm not stealing anything from Chaikin. I just prefer the consistency. But in reality, if I were to trade this, I'd probably be looking at the SMH, which is a much more liquid ETF. But here we got a medium-term entry signal. So that's a moving average crossover signal, the 10 above the 40. Now, this is important because the XSD or the SMH or semiconductors are one of two economic bellwethers. Semiconductors and transports is the other one. When those are bullish, generally speaking, the market will follow. They're just so important to the overall economy. So to see that means, and to see this signal, this moving average crossover signal, along with the metrics that I need to support it, that would probably convince me to take a trade, which obviously I didn't do because I'm yakking here. All right. But what has to be true for a moving average cross? Well, we know that one of the two senior timeframe trends is bullish, right? Because we just had a moving average cross. There it is. These were both previously bearish. I can live without the long-term trend being bearish as long as maybe the market sentiment, meaning the forecast is for the long-term to get better. So we go over here to the long-term forecast, and yes, it is neutral plus. So I need at least bullish or better in one of these two timeframes. And in the timeframes that aren't bullish or better, I'd like at least the forecast in the long-term to be neutral plus. And I definitely need 5 to be bullish, and then this to not get into the danger zone. Okay, just like before, you don't want to take a trade where prices dipped into the danger zone. Heads up, okay, if we close that way, and bullish 50 zone in the near term is great. We can't have bearish on either of these time frames. So if we stay unbearish here, bullish here or here, and then at least neutral plus where we're not bullish here, we're good to go. That's a valid signal. And the other thing is tailwind scores should be 50 or better or close enough. You could probably round it up, right? So I'd say XSD for me looks like there's enough positive data there for me to take a shot. Now I did this, you'll notice, without having charts to look at. Charts will make this a lot easier because I know what danger zone 5 and heads up 10 means, and you'll come to understand it over time. So here's my suggestion. Until you kind of get used to my cheat sheet vernacular, just build watch lists off cheat sheets to start with, and then pick 1 or 2 trading signals that you, if you don't have your own, believe me, these are very basic trading signals, and you may have much better ones than I do. Use the cheat sheets then to just populate watch lists and then wait for your own signals to fire. Or focus on 1 or 2 cheat sheet metrics that make the most sense and are the most comfortable for you to manage and get really good at them. I would strongly recommend the moving average cross system. It's a basic beginner system. And yes, in markets that are undecided and where there's 2 camps and there's a lot of two-way trading, you can get whipsawed using a moving average strategy. Moving average strategies work way better when the major indexes are all above 50 and trending higher. No question about it, okay? But it is a very simple in and out system. You get in on a moving average crossover up, and then more aggressive traders may want to get out when and if price crosses back down below the 40-period moving average. Less aggressive traders that are more patient and willing to live through some drawdowns might wait until those moving averages recross to the bearish side. All right. When you see this on charts, you'll understand. The final thing I'd say is, and again, you're going to be trading a more liquid instrument than semis, but I mean, this version of semis. The other thing I'd say is when you use a moving average crossover system, it's good to have an option strategy in your back pocket that involves overwriting call options to lower your cost basis. One of the things that always happens after a moving average cross, remember, price has gone pretty high on a relative basis to get the moving averages to cross. And after they cross, oftentimes price will come back down 2 to 5 days. Sometimes, they'll consolidate for even a week or two after moving average cross before going higher. And that can be a little bit painful and off-putting. One of the things that I'm going to show you over the coming weeks and months is how to mitigate that moving average crossover drawdown where the trade is still healthy and intact, but on paper, you don't like to, put a couple of naked call options on or, $5,000 into a stock only to have it turn into $47.50 within a blink of an eye, right? So I'll show you a technique where you take out of the money call options and sell them against your holdings. And when we do this with stocks, we call it covered calls. When we do it with options, some people call it a poor person covered call or a covered call on steroids. I just call it an in the money diagonal. And so I will explain that trade setup and how to manage that in coming videos. It's one of my go-to when I'm long and willing to use options to chase price performance to the upside. I will often sell calls against that holding to lower my cost basis and get me through drawdowns. And it keeps me in the trade longer. All right. Whew, that was a lot. Hope you like and subscribe here on YouTube, and that most important, you subscribe to my newsletter, which will start coming into your inbox immediately over the weekend. Sometimes I send more than one a day. So you may want to put a special place, a special folder. So when you hear from me, you make sure to get my announcements in real time because they come a lot and you could get a little numb to them. But because I think I'm going to be able to really help you out as a educational / demonstrator of trading, not as an advisor. All right. Have a great weekend. We'll talk to you soon. And thanks for watching me. If you got this far, I know it was a little painful. I'll get better. See ya. Hold on. I'm still trying to shut this off. End broadcast. There we go.